Hi, everyone. I'm Mike Pacito with I Am Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the I Am Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. So for this August episode, we're going to channel a recent write-up Andrew did for Hedge Nordic called The Awkward Problem with Managed Futures ETFs. It's a catchy title, but to be clear, it's not a problem for investors because we think ETFs, and of course DBMF specifically, are a positive evolutionary development on that side of the ledger. I'll leave it there and I'll let Andrew color in more lines on that topic and more as we dive into the month that was August 2025 in terms of performance, attribution, and positioning. Over to you, Andrew.
Thanks, Mike. So while the macro backdrop is decidedly risk on, so Liberation Day is yesterday's news. The brief panic about AI is a distant memory. So stocks are melting up and bonds are having a great year. So few are worried, right now that is, that stocks and bonds keep moving in tandem. Now, a short aside on that, every wealth management model is built on the premise that bonds would have low correlation to stocks and bonds. So positive correlation plus a big drawdown in 2022, plus higher volatility, plus returns below cash, mean that bonds really ain't diversifying stocks anymore. So allocators have two options: find things that do, like managed futures, or find things where you can pretend it's not true, like private credit. Anyway, in CTA land, after painful whipsaws early this year, it feels a bit like things have reverted to normal. Let's certainly hope so. DBMF rose 1.33% last month, slightly ahead of both the SocGen CTA index and Morningstar category, and is still outperforming the hedge funds by more than 600 basis points year to date. Since the end of 2023, so a bit more than a year and a half, DBMF has outperformed the best and brightest hedge funds by a cumulative 1,200 basis points. So now let's drill down into this a bit. As Mike mentioned, here's a bonus slide from an article that I wrote on, quote, the awkward problem with managed futures ETFs. Now, like DBMF, the average ETF has materially outperformed the average hedge fund and mutual fund in 2024 and 2025. On the left shows hedge funds, then mutual funds and ETFs for 2024, and the same for 2025 through July. Now, it's not an isolated incident. Somewhere between 80 and 90% of ETFs are outperforming. So this upends a cornerstone argument of typical allocators. More expensive, more complicated products are supposed to outperform, and yet they're not. Our explanation, which I walk through in the article, is that more complicated strategies generate amazing returns in theory, but negative alpha once you factor in implementation costs. Now, if you didn't see the article, hit Mike and he'll get you the link. And if you want to dig in live, please do feel free to reach out. So here's our year-to-date performance. We bounced back from the rough period after Liberation Day. Both hedge funds and mutual funds went down more and bounced less. Why? Most likely from negative alpha from more complicated models and esoteric instruments. So how could this have played out? Let's say a big hedge fund with hundreds of positions starts to see sharp whipsaws across markets. Those whipsaws appear much worse in liquid markets. Now, sophisticated risk tools flash red, and they start automatically trying to sell positions into what is now a very illiquid market. So that's a great way to give up years of returns and crystallize losses, which I think is what you're seeing in this chart here. Now, here's our inception to date performance from 2019. So over more than 6 years, we've added 300 basis points of returns relative to hedge funds and more than doubled with more than double the Sharpe ratio and a correlation approaching 0.9. Our strategy track record shows similar performance back to mid-2016. I just don't think it's controversial anymore to say that we're picking up the same signal as large hedge funds, but we believe we're delivering it more efficiently. This is why we say, quote, fee reduction is the purest form of alpha, although we should probably modify it to say that, quote, efficiency can deliver more alpha to clients, end quote. And here's our slide on volatility-adjusted positioning. The green bars are the volatility-adjusted exposures of our 10 futures contracts at the end of August, and the red dots are positioning at the end of June. This quarter, CTAs have built confidence in this risk-on market. Long exposure to crude oil and gold rose. We reestablished a long position, primarily against the yen, a long dollar position, primarily against the yen. There is significantly more conviction about a drop in yields, presumably the market's signal about rate cuts, and equity has been tactically increased. Now remember, please, that the portfolio is quite dynamic, so if interested in our positioning on a given day, it's best to check the website or reach out to Mike directly. And here's our year-to-date contribution. This really hasn't changed much since last month or even the month before. We made money in gold and crude oil. We were wrong-footed by the euro. We struggled a bit with treasuries and got behind equities and made money there. Now, with that, I'll pass the baton back to Mike.
All right, thanks, Andrew. So let's wrap up with long-term performance numbers for DBMF. Annualized return since inception, including the month it was August 2025, is now 6.65%. That's ahead of the SocGen CTA index by over 300 basis points annualized. It's also ahead of the Morningstar systematic trend average by over 410 basis points. Long-term outperformance against the traditional diversifier for equities, that being bonds as represented by the Bloomberg AG, remains well intact, DBMF outperforming by over 530 basis points annualized. And I'll add here in closing that DBMF is now the largest managed futures ETF by AUMs, with over 1.4 billion in assets, almost all 1.4 billion in assets as of the end of the month of August. We're positioning this strategy to be the institutional grade, efficient fiduciary choice for this asset class. And to that point, investors have responded, and we thank, as always, our clients and our prospective clients for your confidence and your interest in DBMF. So if you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.